PPI slowing to 10.1% year-on-year in November from around 10.6%. So marginal slowing coming through there, but we're still sitting in double-digit territory.
Exactly, still very strong. I mean, we'd look for slightly above consensus number print of like 10.9, so definitely surprised to the downside. I think it was from a mixture of simple commodity prices being lower, that sort of thing, but also a little bit as well. You could see some evidence of lower demand externally coming through as well, reinforcing a view perhaps that the external slowdown coming both from Europe and Asia hitting South Africa a little earlier and a little stronger than perhaps first expected.
Well, let's touch on the CPI number that was also released, coming in at around 6.1%. Most were expecting around 6.2%. The point is we've reached the target band that we know that Reserve Bank Governor Jill Markets said was only going to be breached in the first quarter of 2012.
Well, exactly. It's happened a little earlier than expected. It was mainly on food prices, the overall upward move, but the downside surprise in itself was also caused by food prices, surprising us a little to the downside. Also, sort of core consumer items and services as well also showed a little bit of a downside surprise versus my own model as well. So there was no real dramatic surprise there in the sense that we're still climbing higher with base effects and things. We'll probably hit around 6.5% in January, reading that comes out in February. And from then, obviously coming back as food prices start to fall off in particular, and we get base effects coming through as well. So the big view really for next year is, does inflation come back to target in Q4 as the SARB thinks, or actually in Q2, which is my own view, and that's very much up to what you're factoring in the currency.
Yeah. Well, Peter, at the end of the day, and we've spoken about this quite a bit on Closing Bell with regards to a stagflationary environment emerging, given the fact that the likes of inflation is double that of what we'll see on the growth perspective. Does this concern you going into 2012?
Well, the trouble for South Africa really is that you need a kind of Goldilocks timing going on between external growth and internal growth. And when I look at what's going on in terms of my GDP forecast, I see pretty weak external growth through Q4, through the first half of next year. But still, domestic economy doing pretty well. But then them swapping over in the second half of the year, you get a slower internal economy, worse domestic demand, but then hopefully the external dynamic recovering slowly through the second half. So really you need those two to cross over in kind of a perfect way. Otherwise you do get into a more severe negative growth scenario, and that's really the challenge, I think, for South Africa next year. It's also why actually the window for easing from the SARB is actually quite small, because you will have two different strong growth stories to choose from across different halves of the year.
Peter, you're also out with quite an interesting report with regards to the province's crisis that has started to come through with regards to financial and cash flow issues. And you highlighted Limpopo, Free State and Gauteng leading to direct involvement by the government. Is this an economic issue that we're dealing with right now with regards to revenue flows, or do you think that the issues emanate from other parts of the overall government structure?
Well, there is certainly a cost to the National Treasury that's going to come out of this, but really it's nothing to write home about. It's more the structural underlying issues of how both provincial and indeed municipal governments work in South Africa, and the theory of cadre deployment that the ANC has, which leads at the end of the day to inefficient financial management, which is exactly what we've seen coming out in these provinces. Investors don't normally see this directly. When you go to Pretoria with a group of investors, you obviously see very good civil servants there where these sorts of issues don't really come up. But it's clear now from what's going on that things are not quite right in these municipalities at a departmental level, and the government has to get in there and try and sort it out. And it's very interesting, of course, that Trevor Manuel highlighted this issue as a key drag on long-term development in South Africa in his planning report out recently as well.
Peter, let's touch on the developments in the Eurozone. The EU summit, of course, met with a bit of optimism, and then that faded very quickly. We saw downgrade coming through with regards to some of the big financial institutions in the Eurozone, the likes of the UK sitting on the sidelines and not getting involved in this fiscal integration that many people have been talking about. What is your sense with regards to how things are going to play out going forward? Right now, again, it seems that we're not really finding any real action occurring by the big policymakers.
Exactly, there's still no bazooka in sight, and I think people got overexcited by the sort of diplomatic issues of the UK involved in the summit last Friday, when actually the real news was the fact that we basically had a capping of the ESM bailout fund at 500 billion. That was smaller than expected. We had no further money for the FSF in the short term. There was no real new policy, and at the same time we had basically a tethering together of both the Eurozone and a number of non-Eurozone countries in pushing down the line on austerity, and that's going to be further drag on growth going forwards from the Eurozone, not just this year but over the next sort of 10 years as they latch themselves into this ever closer union. So really it was a pretty poor picture, I think, overall. Still no sign of a bazooka. The markets have come to understand that the Fed discount window for dollars was actually not all it was hyped up to be. There was not really a shortage of dollars out there. So really we're no further forward particularly than a few weeks ago, I would say.
Peter, also just taking onto the bigger picture here, where we see the likes of the ECB saying that they're not going to be embarking on aggressive bond purchasing. You're talking about the big bazooka. Is this the big bazooka that we are expecting down the line?
Well, this is really what actually surprised markets, I think, somewhat last week with the ECB decision. And Draghi basically closed off more strongly than many people thought he would this notion of monetary finance, light QE, whatever you want to call it, coming next year. And at the end of the day, if we think about our own forecast and Nomura for the Eurozone, it's basically a view that the whole Eurozone breaks apart, or you have the ECB doing something along the lines of monetary financing. And it's one way or the other. We think ultimately push will come to shove and the ECB will have to jump and undertake some form of QE or monetary financing, whatever you want to call it. But it will only do that at the very last minute when it realises that the entire future of the Eurozone is at stake. And we're not at that stage yet. We need a little further to go. Things need to get worse before they can get better in that sense.